Hi there, Mr. Evans here, looking at a video on interest rates. So we've worked through a couple of these bullet points now. We are just here. So interest rates are the cost of borrowing money and a reward for saving. It's going to be useful if we are considering which AQA wants us to do, the impact on business costs and demand. It's going to be useful to consider the impact that changes in the interest rate could have on consumers and businesses. So just to put it in a bit of context, here is a graphic taken from the BBC website showing changes in the UK interest rate, the base rate, which is since 1997 set by the Bank of England. So you can see that historically we are living through a period of very, very low interest rates, extremely low interest rates, 0.25%. It would have been unthinkable, when I was growing up, to have such low interest rates, and looking back to almost a 15% rate of increase, rate of interest. Which is obviously extremely high compared to where we are now. So let's have a look at changes in the interest rate, and I'll start off by having a look at how a fall in the interest rate might affect consumers and households. Now, it's really important to remember when we are discussing interest rates that there's two effects of a change in interest rates. There is an effect on the cost of borrowing and an effect on the reward for saving. So the cost of borrowing first. Remember, we're talking about households. If the interest rate falls, what's going to happen to the cost of borrowing? Well, the cost of borrowing money is going to fall, and therefore incentives to borrow money, such as on credit cards or to get a mortgage to buy a house, those incentives will rise. On the other hand, the reward for saving money, for putting money in a bank account and receiving the interest on that, is also going to fall. Okay, so there's not much incentive to put your money in the bank and save it because you're not getting a huge return on it. What the Bank of England is trying to achieve when it cuts the interest rate is an increase in spending in the economy. So we can say that consumer demand is likely to rise when there is a fall on the interest rate because of the impact on the cost of borrowing and the reward for saving. Therefore, businesses will tend to see an increase in demand for their products. Now, obviously, the effect on an individual business will vary. If the item is a big ticket item that people tend to buy on credit, like a sofa or a car, a cut in interest rates may have a big effect on that business. If the business is a supermarket, selling essential goods like food, then the changes in the interest rate really may not have too much effect. So it's going to be important to consider the context of the business if there is a question about interest rates changing. Okay, so interest rates can go down, and they have done in recent years. Really, the only way that interest rates can go from now on surely is upwards, although having said that, there are negative interest rates in place in the world at the moment, places like Japan, but presumably the next rise that we have in the UK will be upwards. So what effect is that likely to have? And this time we'll look at the effect on businesses. So again, whenever we're talking about interest rate rises, remember to talk about the two aspects of interest rates. Number one, the cost of borrowing. If a business has borrowed a lot of money, or is thinking about borrowing money, an increase in interest rate will increase the cost of borrowing. Okay, so if the business has outstanding debts with the bank that haven't been negotiated on a fixed interest rate deal, then those repayments are likely to increase. Okay, any investment that the business was planning in new factories will be made more difficult if it becomes more difficult to borrow money, if indeed the business was planning to borrow money to fund that investment. At the same time, businesses will be more incentivized to save any money that they have. Businesses can save their profits, of course, just like people can. So, it becomes more appealing to put your money in the bank, especially for businesses if they'll know that this same effect is happening to consumers. So consumers will be finding it more expensive to borrow, their mortgage repayments may well have increased, and consumers are likely to be saving more as well. So businesses overall are much likely to save their money and not invest. Business costs are likely to increase if they are indebted, if interest rates go up. So, in summary, we could say that an increase in interest rates may increase the cost of the business due to higher repayments and reduced demand for their products. And fall in interest rates might reduce business costs because they can borrow money more cheaply. Their loan repayments may fall if it's on a variable rate basis, and there could be an increase in demand for their goods as consumers are more willing to spend money. This would depend on the context of the business. If the business is selling a luxury product, they're more likely to be affected by changes in interest rates than the business selling necessities. People will continue to buy necessities regardless of the interest rate, and the impact of the changes on costs will depend on the amount of money that they have borrowed, their level of debt. Okay, so I hope that helps clarify the impact of interest rates on businesses.